My name is Mike Bennett. I'm the Chief Operating Officer and co-founder at Encore Estate Plans. We produce estate planning documents, and we help financial advisors in certain situations produce estate planning documents for their clients. Today, we have Kathleen Davis Whitemore from FinCW. We have a very, very cursory look at what we do with IRAs. Within an estate plan, we're provide you some information on when it might make sense to name a trust as a beneficiary in a qualified account. That's surface level compared to what we're doing today. And so today I'll be turning over to Kathleen from Financial Cloudworks, who's going to take us on a journey of navigating inherited IRAs. So take it away.
Thank you so much, Mike. I'm really glad to be here. Thanks, Encore, for hosting me. I'll just tell you a little about my background. I am the Chief Marketing Officer for Financial Cloudworks, but the past 22 years I've spent with a large financial firm, always in the IRA group. So I'm an IRA subject matter expert. In fact, the team calls me the IRA Oracle because I love digging in deep to the rules. And today we're going to dig in deep and learn more than you might ever wanted to know about inheriting IRAs. So I want you to grab a compass. We're going to about set sail on the journey to master the key coordinates of inherited IRA distributions. And during the slides, you'll figure out what the answer is or isn't. Did we at least get the whole numbers? Did they show up for you? I can't always see it on my end. No at 65%, yes at 35%. Thank you. So we'll find out as we go who was right. But first, something from our legal and compliance. All rights are reserved. No part of the presentation can be reproduced, distributed, stored in a retrieval system, or transmitted in any form, in any means. We do not provide tax or legal advice. We don't interpret trust documents. Don't use this as specific legal or tax guidance. Consult with your own legal and tax advisors. Now on with our program. So today, here's our voyage together. We're going to chart the course, which is going to learn the key tax rules for inherited IRAs. We're going to read the passengers of the voyage. There are different types of beneficiaries and how they're treated. You're going to have the flow of fortune, which is distributions and timelines, and last, some captain's tips. There'll be some final thoughts from the helm. Now, before any journey begins, the wise navigator consults the map. Today, I'm going to help you do the same. We're going to chart a true course through the Secure Act, what changed, what didn't, and the beneficiary options many advisors still overlook. When you see when RMDs, requirement of distributions, are necessary, how beneficiary categories really work, and the tax rules that shape every decision. By the end, you won't just know the rules, you'll know how to steer your client through them with confidence. Now, you probably heard the saying, nothing is certain except death and taxes. But I have a fun IRA Oracle fact. Ben Franklin didn't coin that line. It actually traces back to a 1716 play by Christopher Bullock called The Cobbler of Preston. Even the classics can be credited to the wrong source. So it's no surprise that inherited IRA myths spread like norovirus rumor on a cruise ship. And that's why they call me the IRA Oracle, because I love it. I'll tell you, I admit it. I love breaking down the rules to make them actually make sense. I spent more hours than I care to admit buried in the Internal Revenue Code. I'll call it the code today, just so you don't have to. But here's your reality. If you're working with clients who have IRAs, taxes are unavoidable. You may not be giving tax advice, but you're absolutely educating clients about tax implications, especially when it comes to inherited IRAs. Now, here's something interesting. If you search for synonyms, you'll find we have far more words for death than we do for taxes. And that says a lot about our collective discomfort with the topic of death. But here's some good news. Even by the end of this presentation, if the word death still feels a little heavy, you will feel confident talking to your clients about what happens to an IRA after someone dies and the tax implication that comes with inheriting one. One of the first questions a beneficiary is going to ask you is, will I owe tax? And like any good navigator, you know that answer depends on the type of IRA they're sailing. With a traditional IRA, you have to watch those tax currents. Traditional IRAs are typically funded with before tax dollars, so distributions are taxed as ordinary income. The distributions are added to the beneficiary's other income, possibly pushing them into a higher tax bracket. Now, if the original IRA owner had after-tax contributions, a portion of the distribution will be tax-free, and that's where the pro rata rule comes into play. So here's your Oracle tip. Check to see if the deceased filed the IRS 8606. I want you to think of it as the logbook for after-tax contributions. Now, most traditional IRAs are fully before tax, but it is wise for beneficiaries to review the owner's tax returns just to be sure. Now, for Roth IRAs, it's generally smoother sailing because they're funded with after-tax dollars, so distributions are generally tax-free. But here's the catch. The account must have been open and funded for more than 5 years. If it's less than 5 years, the earnings portion of the distribution is taxable, and this is from when the owner did it, not for the beneficiary. If it's more than 5 years, the distributions are considered qualified. It means there's no tax owed. But what about that 10% additional tax? Now, I did foresee you were going to ask that question. When it comes to inherited IRAs, the IRS offers a moment of calm seas. The 10% additional tax simply does not apply. It doesn't matter if the beneficiary is 19 or 79. There is no 10% additional tax for early or pre-59.5 distributions on any amount taken from the IRA they inherited. But why? Well, that's because every inherited IRA distribution is coded with a 4 on Form 1099-R. It stands for one unmistakable word, death. And much like dolphins in open water, that word surfaces often. In the tax code, death is an exception to the 10% additional tax. So while many aspects of the inherited IRA rules feel a little choppy, this part really is some smooth sailing. Now, we've charted a course through the tax waters of the inherited IRAs. Time to meet our passengers, which are the different types of beneficiaries who each play a unique role in this financial voyage. Welcome aboard. Every successful voyage depends on knowing your passengers. Each one has a different role, and the IRS has different rules for how they're treated. So here's our plan today. We're going to identify the 3 main categories of beneficiaries. For each, we'll uncover specific rules that apply because each one's treated differently under the law. And we're going to keep an eye on the horizon because just like sudden storms at sea, unexpected tax rules appear and cause trouble for the unprepared. So heads up, understanding these rules for each beneficiary is essential to avoid running aground on tax complications. Before sailing, you must first identify the beneficiary category your client is. Because the IRS didn't give us one universal map, they issued 3 slightly different charts depending on who's aboard. The first thing you need to know is simple. When did the IRA owner die? Our key Lighthouse date is January 1, 2020. If the IRA owner died before 2020, the stretch IRA is still on the table for all individuals in certain trusts. But for deaths after 2019, the SECURE Act dropped anchor and introduced new rules for individual beneficiaries. So let's start with NDB, those non-designated beneficiaries. I want you to think of them as cargo, not passengers, because they're entities, not people. They're charities, estates, and non-qualified trusts. Now, I generally hope you don't run into these at sea because they're already not the best recipients of retirement assets, and the IRS does not roll out the red carpet for them. Next are our DBs, or our designated beneficiaries. Now, these are individuals, but they're not the VIPs who qualify for more favorable provisions. They're children of the IRA owner who are over age 21, individuals more than 10 years younger than the IRA owner, and that's based on dates of birth, not attained age. Individuals who are not chronically ill or disabled, primary beneficiaries of a qualified or a look-through trust who are not the spouse or chronically ill or disabled. Now, these passengers set sail with the 10-year rule. There's no stretch, no premium suites, or priority boarding. Last are EDBs, or Eligible Designated Beneficiaries. Now, these are the VIP of the beneficiary world. They're the ones who still get the favorable rules and the cruise perks. Now, listen carefully. This is where my question in the beginning came into play. They are children of the IRA owner under the age of 21 or their qualified trust. Individuals not more than 10 years younger, the same age, or older than the IRA owner. Individuals who are chronically ill or disabled. Primary beneficiaries of a qualified trust who are the surviving spouse or chronically ill or disabled, and of course, the surviving spouse. So these beneficiaries get the more flexible options, including the life expectancy method. So yes, it is still available. And their distribution timeline is far nicer than what DBs receive. Now I have a quick oracle warning from the crow's nest, because I'd be remiss if I didn't highlight a subtle but hugely important detail. Someone who is not more than 10 years younger than the IRA owner is an EDB if they're named outright. If instead they are a beneficiary of a trust, they are not considered an EDB. Yes, it's the same person, different results, completely different tax timeline. it's time to chart the two coordinates before choosing a distribution route. I want you to think of these as the latitude and the longitude of inherited IRA planning. First is, what is the required beginning date? The RBD is the date by which the IRA owner had to begin taking RMDs. It's generally April 1st of the year after the year they return RMD age. And that's our second navigational point. What's the owner's RMD age? Well, they made this lots of fun in the code. So it's 75 if you're born in 1960 or later, 73 if born between 1951 and 1959, 72 if born from July 1st, 1949 to December 31st, 1950, and 70 and a half if born before July 1st, 1949. But here's a fun nautical fact for you. Roth IRA owners are always considered to have died before their RBD, since Roths have no RMDs due during the owner's lifetime. No RMDs equals no RBD to reach. Only all IRS rules are that simple, but alas, here we are. Now, getting these details up front will allow you to do a few things. Choose the correct distribution path. Remember, each beneficiary category plus RBD status combination leads to a different route. Some are COMCs, some are choppier. You're going to avoid costly tax missteps. One incorrect assumption about the RBD can send your client straight into a tax storm. And you can confidently guide your client through their inherited IRA journey. Think of this as your compass. Without it, you're just drifting. Now, before we dive into the details, because I know you can't wait, here's a high-level map. Think of this distribution compass and a quick guide showing you which routes apply based on who the beneficiary is. The individual beneficiaries are two types, the DB or the EDB, and we've met them already. But how does their status determine their course? DBs follow one of two routes, the 10-year rule or the 10 years with RMDs, if the owner died on or after their RBD. This is where it starts coming back into play for you. EDBs, on the other hand, chart a different course. They can use the life expectancy option, it used to be called the stretch strategy. So it is still available for some, which is annual RMDs over the EDB's lifetime with the term certain schedule. Now, I'm often asked, well, what if a beneficiary wants more empty account sooner? Remember, M in RMD stands for minimum. So as long as the minimum is met, they can always take more. Now, they can also do a lump sum, which is cash out the entire account. They can disclaim, refuse all or just a portion of the account. That becomes a powerful planning tool. And there's the spousal option. Only a surviving spouse can treat the inherited IRA from their deceased spouse as their own. Now, when we're talking about an entity, we're back to NDB waters. And the Secure Act did not rewrite the distribution rules, but they still require precise navigation. If the owner died before their RBD, NDB failed the 5-year course. If the owner died on or after their RBD, the ghost rule applies. Why is that named? And that's the last year the IRA owner still had a pulse. The IRS is nothing, it's not literal. So RMDs are calculated using the owner's life expectancy divisor based on their attained age in the year of death. Divisors are reduced by 1 each year thereafter. And in some cases, an entity or a trust may be able to disclaim all or a part of their inherited IRA. But this is choppy, legally nuanced waters and should be handled with experienced legal counsel. For your qualified trust, if the beneficiary of the qualified trust is a DB, they have the 10-year rule or 10-year with RMDs. If it's an EDB, which is a spouse, chronically ill or disabled, or the minor child under 21, it's a life expectancy option. Again, you could do 10 years, but as long as they take the minimum, they can always take more. Here's another Oracle tip. This is a high-level map for trust. It's not the full chart. Trust planning is often complex and layered. Clients who name trust, or if the trust has already been inherited, the trustee should work closely with the qualified estate planning attorney to avoid running aground of tax issues. Now we're going to go into the flow of fortune. Our passengers are assembled, and now it's time to chart a deeper course into the world of inherited IRA distributions. One pivotal point. Now, it doesn't matter whether the inherited IRA was a traditional or Roth. Remember this. Once it's inherited, the distribution rule is the same. That keyword is inherited. And in the flow of fortune, timelines, rules, and real-world strategies are going to converge. When you master them, confusion gives way to clarity, and you become the navigator your clients trust when the waters turn uncertain. Our passengers are aboard, and now we're going to turn to the rule that shapes most of their destinies, and that's the 10-year rule. When the owner died after 2019, remember we looked at those different points of what we need to know, and they die before their RBD, no RMDs are necessary in year 1 through 9, but the entire balance must be distributed by the end of year 10. And I got a little hint. The IRS loves this plan. It's a big tax wave hitting all at once. Now, if the owner died on or after their RBD, DBs do take RMDs through year 1 through 9. Then in year 10, the IRS delivers its classic message: everything must go. It's like the IRS saying, don't worry, you take a little now, I'll take a lot later. One more reminder, the IRS is no longer automatically waiving the 25% excise tax for every dollar of the RMD the DB fails to take. Now, these are the rules. There's no parlay on this voyage. The IRS storms in like a pirate crew and takes what's owed. I have a warning for you. The countdown is real. Beneficiaries inherited in 2020 still have 5 years remaining. There's no do-overs. There's no extensions, and there's no mercy from the IRS. The clients haven't touched their inherited IRAs yet. The window's already closing. You need to move now. Oh, I know what some of you are thinking. The oracle must be wrong. There's only 4 years left. But are you sure? Year 10 trips up more advisors than almost any other timing rule. So before our clients take steps into dangerous waters, let's clear up the most common mistake. But first, I want to test the room, because the 10-year rule confuses people so reliably. I'm this close to charging a confusion tariff. So our IRA owner dies in 2020. Year 1 is 2021. So in our quick poll, we want to know which date is the deadline. Is it going to be December 31st, 2030, December 31st, 2031, January 1, 2030, or January 1, 2031? We'll give you all a minute. If we still have answers coming in, we'll wait a second or two longer, but if we think we're done, we can close and show the results. Okay, I think I'll go ahead and call for the poll to close. Let's see if we see the results. So we had 46% to December 31st, 2030, and 50% to December 31st, 2031, and 4% to January 1st, 2031. Let's see who was right. It's December 31st, 2030. Now, this is the mistake I often see advisors assuming, and you know what assuming means, that the 10-year clock starts in 2021 and therefore ends in 2031. But no, 2021 is year 1. Add 9 more years to that starting point, and you land squarely on 2030, the 10th and final year. Now let's circle back to my warning. If 2026 is year 6 and you add 4 more years, you reach 2030. But I want you to hear a cleaner way to think about it. 2026 is the year we're standing in. You're going to treat it as year 1 of what's left. Year 1 plus 4 is 5 years total, and you guessed it, we're at 2030. So I want you to think of it like setting sail. The voyage begins the moment you leave the harbor, not a year later. Now, we open today with the truth that anchors us all. Death and taxes shape the water we sail. The 10-year rule is where those two currents collide. The IRS is the iceberg in these waters, and most beneficiaries have no idea what's sitting just below the surface. I want you to think Titanic, but you're at the helm. With a clear understanding of the inherited IRA rules, you can guide clients safely through the tax currents and around that iceberg. Now, 10 years feels like a long time till it's not. If your clients only take RMDs or nothing at all, they could be facing a tax tidal wave in year 10. Even a modest inheritance, say $100,000, can grow significantly over a decade. If the beneficiary waits, then that final forced distribution could easily push them into a much higher tax bracket. In fact, an inherited IRA behaves a lot like a Roth conversion, but without the control. It's because The tax dollars have to be pushed through the tax wall, whether the beneficiary is ready or not. And the IRS is waiting, like the song says, on the other side with arms wide open. And even in the tax doom and gloom, there's a bright spot. Beneficiaries who inherit a Roth IRA usually escape this fate. Up next, I want you to meet Natasha, whose journey will illuminate how intention, timing, and guidance can avert collision with that tax iceberg. So here she is. I want to introduce you to Natasha. She's 50. She has a busy career, a wonderful husband, 2 great kids, and like most people, not thinking about tax strategies. And then life happens. Her father dies, leaving her with a $100,000 traditional IRA. She's a designated beneficiary because she's not the IRA owner's minor child. She's not their spouse. She's not more than 10 years younger and is not chronically ill or disabled. Her financial professional confirmed the last 2, so there's no question about her beneficiary category. And I will tell you, as you know, we can't look at someone if they're chronically ill or disabled, so that is a great question to ask. Now, she's sad but grateful for the inheritance and has no idea the IRS has quietly stepped into her already hectic life. And Natasha does what so many beneficiaries do. She assumes, there's that word again, but she has plenty of time. 10 years, that's so far away. I'll deal with that later. Right now, I've got college visits with the kids, a major work presentation, and a 25th anniversary to plan. But as you and I know, later is often when the trouble starts. So we're going to follow Natasha down 3 different paths with 3 different futures. The first 2 I like to call the IRS strategy. That's wait until year 10 or take only RMDs. And that third option, that's going to be the client strategy. So let's first look at what happens when Natasha does the do nothing till year 10 path. She's busy, life gets in the way. Meanwhile, that untouched $100,000 keeps growing steadily, quietly at 8%. She doesn't see it, but she's drifting closer and closer to that tax iceberg. And in year 10, it hits. And she's faced with a $215,000, almost $216,000 lump sum distribution. It's going to push her in the 24% tax bracket as a joint filer. Now, if she was single, that same lump sum would shoot her into the 32% zone. And this is before counting any other income for the year. Does this sound like a good deal? It is for the IRS. Now, many clients believe they're fine because they've been taking RMDs. Well, let's see how that one plays out. So in the second timeline, Natasha is going to follow the RMD rule. But here's the catch. Those RMDs are tiny. They're really too tiny to slow down the compounding, and her account continues to grow at 8%. Year 10, she still faces almost $166,000 final distribution she's not prepared for. As a joint filer, she pushes her to the 22% bracket. If she was single, it'd be 24%. Now, is it better than the first path? Yeah. Is it ideal? Not at all. And let's be honest. How realistic is it that your clients have no other income? Even with RMDs, that final 10-year distribution often triggers a significant tax bill, especially when you combine it with wages or Social Security or a pension. Now, let's look at a more proactive option, one that keeps the clients away from that tax iceberg altogether. The third path is the smart one, the advisor-guided one. This is where you become the hero in Natasha's story. It's the client strategy using our proactive method called distribution smoothing. It's going to let Natasha spread her distributions over the 10-year period and factor the RI directly into the calculation. So like Goldilocks, the distribution's not too big, not too small, but just right to keep the IRS at bay. Now, if she has no other income, the annual distributions keep her in the 10 to 12% bracket, whether filing single or jointly. Even added to other income, the amounts aren't likely to push her into a higher tax bracket. So her income stays steady, her tax bracket stays manageable, and in year 10, no collision, no iceberg. Here's the key point. Doesn't matter whether her father died before, on, or after his RBD. With distribution smoothing, Natasha's already taking more than the RMD, if one's even necessary. Remember, the IRS wants you focused on the RBD and the RMD rules. But what they're really hiding is the tax impact. Don't be fooled. So let me ask you, is this a strategy you'd feel comfortable discussing with your client? And do you think your clients will want you guiding their retirement if you help them avoid tax surprises like in the IRS strategies? There are studies showing retirees actively seek advisors who understand IRAs and retirement income planning, not just asset management. This is the exact kind of value that keeps clients for life. So we're going to take a deeper dive into the life expectancy option called the Stretch IRA strategy, because it extends the IRA tax deferral benefits over the longer than the original owner's lifetime. This rule does apply to inherited IRAs again, whether it's a traditional or a Roth. And yes, as long as the minimum is taken, the beneficiary can always take more. It's available to EDBs and non-spouse or QTs that inherited before 2020. It allows those beneficiaries to take annual RMDs. It's usually based on their own life expectancy, starting after the year the owner died. The calculation works like this. It's a divisor from the single life table, the prior year in value, and the term certain method, which means one is subtracted from the original divisor in each following year. The initial divisor is usually based on the beneficiary's attained age, and that means how old they are by 12/31, the year following the IRA owner's death. It's important to know, though, the account must be emptied in the last year when the term and the divisor is 1 or less than 1. So that's nice and orderly, like a good analytical chart. But as with all things IRS, smooth waters do not last long. There are a few important exceptions, and these can change the course entirely. Now, the code has more special rules than a great white has teeth. So let's chart these hidden reefs. Let's look first at the qualified trust that inherited before 2020. We're going to use the age of the oldest trust beneficiary to determine the divisor. We continue using that divisor even if the oldest beneficiary died before 2020. Now, if the oldest died after 2019, hold tight because the Secure X successor rules apply. For a minor child, the IRA owner, I call them the hybrid because they sail under two sets of rules: annual RMDs until age 21. After 21, the 10-year rule begins. Because they were taking RMDs until age 21, they continue RMDs during the 10-year period. And remember, age 22 is year 1. You count forward 9 more years, and by age 31, the account must be emptied. This hybrid voyage can be one of the hardest for clients to understand, which is why your clarity makes all the difference. Now, what happens when we use the owner's life expectancy instead of the beneficiaries? And this happens when the owner died on or after their RBD. They were younger than the beneficiary. We can follow the ghost rule. And it's the owner's life expectancy divisor on their attained age in the year of death. Because remember, that's the last year they still have that pulse. And it's the attained age, what they would have been by 12/31. The divisor is reduced by 1 each year thereafter. It differs from the Benny, where the divisor is found the year following death. And this matters because it preserves the tax deferral for far longer than the 10-year rule. And it gives clients lower annual tax impact, more consistent distribution income, and a longer, smoother planning runway. But, and this is a big but, I cannot lie, it only works when the beneficiary qualifies and understands how these rules apply to your situation. This is where you step into the role of the navigator, guiding them around tax icebergs and keeping their voyage steady, safe, and strategically plotted. Now let's meet our cruisers. Here's Bluey, isn't she sweet? She's 12 years old in 2026, but sadly her father Bandit died in 2023. Because she is the minor child of the IRA owner, her journey begins as an EDB, but only until she turns 21. After that, she sets sail straight into DB waters and the 10-year rule starts. Here's the compass point you must remember. No matter whether Bandit died before, on, or after their RBD, Bluey has 2 navigational rules to follow: taking annual RMDs while she's an EDB and continuing RMDs once she's a DB, all while emptying the account by the end of the 10-year term. So why are there RMDs during the DB's time if Bandit died before his RBD? Well, that's an excellent question. In their infinite wisdom, the IRS clarified in their final RMD regulations that the least as rapidly rule applied to inherited IRAs, meaning even if the owner died before the RBD, if distributions had already begun for a beneficiary, they cannot stop. Think of it like this. It's no different than when the owner dies on or after their RBD and RMDs were necessary and the beneficiary has to continue taking RMDs from the account. Or I can translate this into Oracle speak to make it easier. Once distributions start, the IRS won't let you stop. And yes, the IRS decided that the rule follows downstream. So just like for an owner who was taking RMDs, the beneficiary started taking RMDs, they continue. In this case, Bluey was an EDB that turned to a DB, RMDs continue. It's really fun keeping all the rules straight. Well, it is for me. I think it was a lifetime employment guarantee. So let's look at Bluey's financial forecast. She inherits 175, 250. And even in 20 years of RMDs, her account still grows to almost $423,000. Now it's smooth sailing for most of the voyage, steady RMDs, manageable taxes until that final distribution hits. And at a 35% tax rate, that last distribution becomes a full-blown tax storm. And that's before we add Bluey's future salary once she's earned her own treasure. Well, this matters because RMDs, while they help EDBs, a minor child like Bluey who's a Part-EDB, Part-DB, the hybrid rule creates a tax trap. What's your job as the advisor? Keep her from drifting into rough waters. So what's that smarter course? Bet you already know it. That's right. It's distribution smoothing, but we have a twist this time. Now here's our twist. While Bluey's under 18, she only takes the RMDs, nothing more. But once she turns 18, the course changes. And that's when our distribution smoothing begins in earnest. Why are we doing this? Well, Bluey's headed to college. And the inherited IRA can help cover tuition, books, housing, even her first car. And that last year distribution, it's a manageable about $47,000, which keeps Bluey much more money than she's going to give to the IRS. What's this beauty of distribution smoothing? And it's the flexibility. Each year you meet with Bluey and her family, and you're going to look at the projected account values, her upcoming expenses, Bluey's tax bracket, how much room she has before bumping to the next one. So yes, RMDs must be taken, but anything above that is strategic. You can adjust the sales each year to avoid unnecessary tax drag. And while losing Bandit was heartbreaking, the inherited IRA can be a lasting gift, a financial reminder of his love and support. Now let's turn our attention to the spouse. They are the one passenger on this voyage who gets the best stateroom on the ship. And when it comes to inherited IRAs, surviving spouses have options that no other beneficiary gets. Think of it as a VIP deck pass of the tax code. So there were two main options. You can transfer a role to your own. Now you might be thinking, well, why wouldn't a spouse treat the IRAs their own? It's the red pill of IRA decisions, promising no RMDs until their RMD age. Maybe a stylish leather coat? I can see some of you aren't quite convinced. So I have another quick poll for us. I want to see what you think, and then we'll discuss what the Oracle's answer is. So the question is, when, if ever, do you think it's appropriate for a spouse to open an inherited IRA? Pick one. When they're under 59 and a half, when they're older than their deceased spouse, both A and B, or never. And we'll give you all a minute or so to put your answers in, and we'll see what you've said, and then we'll see what the Oracle thinks. So I give about 30 more seconds, and we'll close it. All right, I think we're good. Let's see what the answers were. So when they're under 59 and a half, it's 38%. When they're older than their deceased was 19%. Both A and B, 29%, and never 14%. Great responses. I'm still not telling you my answer yet. We're going to find out though. So here's what to know before you choose a spouse's path. Here's a critical navigation marker. Once a spouse treats the IRA as their own, that decision is permanent. There's no lifeboats, no tugboats, no rowing back to an inherited IRA. Remember, when you're supporting a recently widowed spouse, you're already steering through emotional and financial stormy waters. They should not be making financial decisions that can't be reversed. Your job is to help calm the waters, not create a rogue one. That's why for many spouses under age 59 and a half, here's the first answer. The safer course is use inherited IRA instead of treating the account as their own. Now, the biggest reason to choose the inherited IRA channel is the 10% additional tax. Remember, spouse treats the IRA as their own and then needs to distribute funds under age 59 and a half. they're going to get hit with a 10% additional tax unless an exception applies. But with an inherited IRA, that additional tax doesn't apply because remember, death is an exception and one of the rare moments when the tax code shows a hint of compassion. Now that we're all on deck why the younger spouse might stay the course of the inherited IRA, let's talk about why the older spouse, someone already at or past RMD age, might choose an inherited IRA. What do you think that reason has to do with? I bet you know it. Taxes, absolutely. When the surviving spouse is older, close to or already at RMD age, rolling the inherited IRA assets into their own IRA can backfire. It often creates larger RMDs, which can mean higher taxes, especially now that they're filing single instead of joint. That shift alone can push them into a higher tax bracket. Here's a couple navigational details to understand for a spouse of any age when they open an inherited IRA. The surviving spouse does not take RMDs until the deceased spouse would have reached their RMD age. Now, why is it RMD age instead of RBD? It's because Roth IRA owners have no RBD. And using RMD age keeps the rules constant for both types of IRAs. Remember, inherited is the key concept. At some point, the spouse must begin distributions from the inherited IRA. And don't forget the least as rapidly rule we've been talking about. It's steering the ship too. RMD age marks the moment that RMDs would have begun if the deceased spouse were still at the helm. So what happened the year when the RMDs must start? If you recall, I told you earlier, the spouse is a VIP of this voyage, and this is where that special flexibility really shines. Spouse has a unique maneuver available. They can choose to roll the inherited IRA into their own IRA at any time, maybe once they reach 59.5, or the year RMDs would have been necessary as the beneficiary. By doing that, the code says they're treated as the IRA owner for the entire year. So if there are any RMDs due, it's as the owner for that year and is calculated with the spouse's age and the uniform table divisor. So by turning to the spouse's own IRA, you don't have to worry about the distribution rules for a spouse's beneficiary. This can be a very strategic move, like adjusting the sails before a storm hits. Now, do you know how to calculate RMDs for a spouse in an inherited IRA? It's not as straightforward as you might think. Calculating RMDs for a spouse isn't as simple as it is for the other beneficiaries. So I want you to grab your life vest because we're headed into some rough waters. Unlike other beneficiaries who use the term certain method, a surviving spouse uses the recalculation method, meaning a new life expectancy divisor is attained annually. I want you to think of it as updating the ship's navigation chart every year with a fresh coordinate. That's part of the VIP deck pass treatment the tax code occasionally hands out. Now, which table applies is where many advisors get swept overboard because this rule was changed with the final RMD regulations. Here's how it works. If the deceased spouse reached RMD age before 2024, it's not when they died, it's when they reached RMD age. Then the single life table is used, just like any beneficiary. If the deceased spouse reached RMD age after 2023, the uniform table is used. Okay, so on the surface, it looks like the IRS accidentally wrote something that feels almost helpful. But is it really? Sure, under certain circumstances, they let a spouse use the uniform table for inherited assets. But that's the same table every IRA owner uses once they hit RMD age. It's hardly a secret VIP deck pass. And let's be honest, how often does the surviving spouse keep the inherited IRA once they reach 59.5? Or once the deceased spouse would have hit their RMD age? In real practice, those waters are rarely traveled. But wait, there's more. Once again, we find more of the code special rules. And this one is where the deceased spouse was younger. And I want you to listen closely because this one's a doozy. For this rule to apply, all of the following must be true. The deceased spouse died on or after their RBD. The deceased spouse was younger than the surviving spouse. And the deceased spouse's life expectancy is longer than the surviving spouse's. Then you get to follow the ghost rule. Now, if that rule didn't make your eye twitch, hang on, because the next one's peak IRS. We have to figure out whose life expectancy is longer. So put your thinking caps on, because the IRS has a surprise math problem for you. How to determine which life expectancy is longer. When the deceased spouse reached RMD age before 2024, you must compare the surviving spouse's single life table divisor with recalculation versus the deceased spouse's single life table divisor term certain. When the deceased spouse reached RMD age after 2023, the comparison shifts to surviving spouse's uniform table divisor with recalculation against the deceased spouse's single life table divisor term certain. Once again, it proves that the rule makers draft these revisions from a landlocked office, not from the real seas we sail every day. So my advice, meet annually with surviving spouse clients and determine whether keeping the inherited IRA still makes sense, because the rules clearly miss the keep it simple memo. Now that we've charted the rules, let's walk through a few scenarios so you how timing, tables, and divisor choices actually play out once you're navigating these waters with real clients. I'm going to walk you through a classic scenario you're going to often see when advising spouse beneficiaries. Here's Lucy. One day she comes to your office to tell you her loving husband, Desi, died late last year. He was 65. Lucy is 56 this year. Because Desi died before reaching his RMD age, Lucy now stands in the fork in the navigational chart. What course should she set? Should she open an inherited IRA or roll it to her own? Let's find out which is better for her situation. In this scenario, the inherited assets are rolled to Lucy's own IRA. Lucy then announces her grand plan. She wants to see the world, and it's a fair request. She's earned some time to embark on the next phase of her life. She also needs additional income to bridge the gap until age 60. Now imagine having to say, yes, you can avoid that during vacation and the extra income, but there's a 10% additional tax on the distribution. Is she upset? Maybe, maybe not. But she'll definitely be upset when the advisor down the street says, you know, the additional tax could have been avoided in the inherited IRA. Ouch. That's a reef you do not want your clients crashing into. Sometimes moving assets into their own IRA is the right call. But on this voyage, timing is everything. Because remember, once the assets are in the spouse's own IRA, the normal distribution rules apply. No RMDs until Lucy reaches RMD age. Smooth sailing. But any distribution before 59.5 is going to trigger the 10% additional tax, not so smooth sailing, unless the distribution qualifies for an exception. And that's a big wave to overlook. Now, picture the second scenario. The assets are moved to the inherited IRA. Lucy still wants to see the world, and she still needs that additional income. This time, you get to say, yes, you can afford that during vacation, and there's no 10% additional tax. Is she upset? No way. And she's certainly not out of interviewing new financial professionals with better retirement account knowledge. Is there any hazards in this version? None. Why is that? It's flexibility. The inherited IRA gives Lucy the breathing room she needs. There's no RMDs because Desi died before his RMD age. Lucy can take distributions before 59.5 without the 10% additional tax. And the best part, when Lucy turns 59.5, or whenever she's ready, she can roll the assets into her own IRA. No RMDs until she reaches RMD age. No additional tax after 59.5. No pressure. Just clear seas and flexible planning. Now let's see Lucy's plan in action. Remember, Lucy told her advisor she needs about $20,000 a year to age 60. Her advisor recommends using the inherited IRA, and together they map out a projection for the next 4 years. $20,000 a year, increasing 4% annually. That's just enough to keep pace with the rising travel costs and the occasional umbrella drink. At 60, Lucy's going to stop taking distributions. But then 2035 rolls around, the year Desi would have reached his RMD age. And suddenly, RMDs are necessary from the inherited IRA. But here's the thing, Lucy doesn't want to take RMDs yet. Oh, it's no problem. She simply moves the assets to her own IRA. RMDs disappear. Storm is avoided, course is corrected, and the problem solved. Now, what if Lucy was older than Desi? I want to shift to a different course. This time, Lucy's just a little bit older than Desi. Some might call her a cougar. But tragically, in this hypothetical scenario, Desi died in 2025 at age 65 before reaching his RMD age. Lucy's 78 years old in 2026. Here's her plan. She wants to tell her advisor she wants to avoid paying more tax than necessary. It's really sensible. No one wants to give Uncle Sam more than required, especially once they've been navigating retirement waters for a while. Her advisor, who's well-versed in IRA rules, recommends a strategic maneuver. Transfer the assets to an inherited IRA. Doing so allows Lucy to avoid RMDs until 2035. the year Desi would have turned 75. That gives her 9 years where the assets potentially grow at 6% with no RMDs, no added taxes, just smooth seas. Then in 2035, Lucy simply transfers the assets to her own IRA. Remember, the spouse has that all-access VIP deck pass. She adds the 1231 balance of the inherited IRA to her existing IRA balance and takes her RMD based on that combined total. Clean, efficient, compliant, no waves, no rocking the boat. Now, let's see what happens when she treats the IRA as her own the year Desi died. Now, nothing was due in 2025 because Desi was the owner and he had no RMDs. Since she rolled the assets into her own, starting 2026, she's the owner and she would take RMDs based on her age. In doing so, she was required to take about $180,000 in RMDs over the next 9 years of the $350,550 she inherited. That RMD amount each year places her in the 12% bracket for single filers. If you add in Social Security, existing IRA RMDs, maybe a pension, then she would be pushed into even higher tax waters. Thriving spouses like Lucy have tremendous flexibility, but only if they understand the options available on their voyage. A simple, thoughtful conversation about the spouse's goals can completely change the outcome. Now, this is great for fairy tale endings, but what happens when divorce hits? Well, let's look. So in this hypothetical voyage, Lucy and Desi have divorced, but unlike many couples who part ways, they still want to name each other as their primary IRA beneficiaries. Sure, it's unusual, but it's not as rare as you'd think. Now, I've spoken to plenty of advisors who run into this exact situation. Sometimes the reasons are tied to health, long-term care planning, or financial currents that don't neatly match the relationship status. But here's the lighthouse you want to keep your eye on. You have to know the custodial agreement, and that's the contract that governs the IRA, and it is the map that determines what happens after a divorce. Ignore it, and you may hit a sandbar. Some agreements state that if the couple is divorced at the time of death, the ex-spouse is automatically disinherited, even if they're still listed on the beneficiary form, tossed overboard, so to speak. However, if the ex-spouse is redesignated as a beneficiary after the date of divorce, they remain safely on board as the intended beneficiary, and this clears the fog around the IRA owner's true intent. This is why it's so important you know your IRA contract provisions, and why I always recommend updating the beneficiary form whenever a major life event occurs. It's the safest port in any storm. We're going to look at Lucy's plan one more time, but now she's a non-spouse beneficiary. Now, she still qualifies as an EDB because she's not more than 10 years younger than Desi. And here's where the navigation gets tricky. Lucy was born in April of 1970. Desi was born in May of 1960. It makes her 9 years and 11 months younger. That 1 month makes all the difference. Had Lucy been born in May, but even one day after Desi's birthday, she would have been considered more than 10 years younger, which means she would not qualify as an EDB. Remember a few slides back when we talked about the attained age, the age on 1231? Well, the IRS apparently decided that wasn't complicated enough, and they added this gem to the rule book too. I know, you're relieved I keep all this in my head so you don't have to. And this is classic IRS rulemaking. You see the tip of the iceberg. The part lurking just beneath the water is what can sink your ship. Because Lucy does qualify as an EDB, she can chart her course using the life expectancy method. Her divisor is 30.6, meaning she takes RMDs over 31 years. They're smooth waters, but only because we navigated the details carefully. Now, gather around, advisors, listen closely. For the currents of inherited IRA rules are treacherous, and only those who think before they sail dodge the IRS sea beast lurking beneath the waves. Now think about your clients. Here's some checkpoints to chart. Do they meet the chronically ill and disabled definition? Only they can tell you. What are the dates of birth for both the owner and the beneficiary? Are they not more than 10 years younger? Minor children of the IRA owner must follow the hybrid course, Part-EDB, Part-DB, to keep them from drifting into unintended waters. Which path does a DDB want to follow, theirs or the IRS's? The younger spouse dies first. Could delaying RMDs a few years reduce the survivor's tax burden? Would a spouse under age 59.5 benefit more using an inherited IRA instead of treating it as their own immediately? And what if the couple divorces? If the IRA owner does want their ex to inherit, update the beneficiary form. If the X does not, they do not want their X to inherit, update the beneficiary form. You see the theme? If the form isn't updated while they're alive, the courts might decide the new heir to the helm as their advisor. That means rough waters for you. So here's another Oracle tip. Review the beneficiary form at every major life event. That's a marriage, a divorce, a birth, a death of a beneficiary, or every 2 to 4 years just to keep the map up to date. And don't forget about asking about updating beneficiaries on their 401ks, other retirement plans, annuities, life insurance, because all of those supersede any instructions on a trust or a will. Now, let's shift our head and examine a more complex trust. So, since it's 5 o'clock somewhere, and this beneficiary can be a real handful, let's hoist a glass, because the waters are about to get interesting. We're going to focus on the qualified trust. This is the one that meets the IRS look-through requirements, meaning you can see through the trust to identify the actual beneficiaries who drive the distribution rules. For a trust to qualify, it must be valid under state law, be irrevocable or become irrevocable at the IRA owner's death, have identifiable beneficiaries, provide required documentation to the IRA custodian. If the trust is qualified, the next navigational markers are the type of trust, conduit or accumulation, who the primary beneficiary is, whether there are multiple primary beneficiaries. All of that determines how long the IRA can remain open, which distribution rules apply. So here's a quick compass check. For a conduit trust, trustee cannot hold or accumulate IRA distributions. Distributions must flow through the trust income beneficiaries. For RMD purposes, only the current income beneficiary is considered. Remainder beneficiaries are ignored. For an accumulation trust, the trustee can hold IRA distributions inside the trust. Now, this will often create less favorable RMD and tax outcomes, but sometimes it's necessary for protection or control. Because the trust accumulates assets, all identifiable beneficiaries count, including the remainder beneficiaries. Now, if there's a mix of DB and EDBs, the stretch is eliminated unless the trust meets the special applicable multiple beneficiary trust, or AMBT rules, and those are for disabled and chronically ill only. And the oldest beneficiary's life expectancy would be used if RMDs are needed. Now, eligible designated beneficiaries of QT are the spouse, the chronically ill disabled, and the minor child of the IRA owner until attain age 21. But remember, here's a twist worth charting on your map. To treat a qualified trust for a chronically ill or disabled beneficiary as an EDB, the AMBT requirement must be met, which is the trust must be split into separate trusts or sub-trusts made upon the IRA owner's death. That trust must be exclusively for the chronically ill or disabled beneficiary. Remainder beneficiaries cannot receive anything until that beneficiary dies. RMDs use the date of birth of that chronically ill or disabled beneficiary. For the minor child, if there is more than one minor child of the trust, the rules are a little more involved when taking RMDs, and the last year the account can remain open. Annual RMDs are required to the youngest turns 21. Those RMDs are based on the life expectancy of the oldest minor child. The account is still emptied 10 years after the youngest minor reaches 21 or dies before 21, and of course, those RMDs would continue. There's one set of rules that governs the RMD schedule, another governs the final distribution deadline. A Voyage with 2 compasses, so you have to navigate carefully. When a QT's beneficiaries are simply DBs, you've reached the calmest waters of trust planning. These are the least complex rules on the map. They follow the 10-year rule or the 10-year with RMDs. And here's the key. The RMD factor will be based on the oldest trust Benny. In other words, the oldest beneficiary sets the pace, whether they like it or not. Now, we've plotted the basic rules, but wisdom lies in understanding the why. We've entered deeper, and some might say uncomfortable waters now, the why behind naming a trust as an IRA beneficiary. But stay steady, I'll guide us through the key currents. It starts with the why. Why was a trust chosen? Should always be your first question when a client names a trust as the IRA beneficiary. Most often, the answer is to be control from beyond the grave. They don't want their adult children spending the inheritance like a gale ripping through a mainsail. But here's the gentle oracle reminder. Those same adult children are probably DBs, meaning they only have 10 years anyway. So the question becomes, would they rather the kids blow through the money or Uncle Sam. Another common reason is chronically ill or disabled individual, can't manage their own finances or hold assets without losing essential benefits. Now, these situations demand thoughtful direction, and a trust often becomes the life jacket that keeps everything afloat. Now, second and third marriages is where you can shine. Blended families are familiar seas. So ask the client, could life insurance provide tax-free income to the current spouse, allowing children from the previous marriage to inherit the tax-filled IRA? Or should the current spouse and children all be named primary, each with their own percentage, say 50% to the spouse, the other 50 divided among the children? And then there's the Roth. Roth distributions are tax-free to the beneficiary once that 5-year clock is satisfied. Because of that, keeping IRA assets in the trust won't have negative tax consequences. This is one of the few calm harbors in the entire trust planning journey. Ask your client, would a Roth conversion be the solution? Now, I could talk Roth strategy for hours, but that's a whale tale for another day. Understanding the why is where your expertise becomes the sextant, the tool that keeps their legacy from drifting off course. Often the trust is chosen simply because no one has discussed the downsides. And I know many of you aren't lawyers and you don't give legal advice, but you're an advisor. And IRAs sit right at the crossroads of tax and legal consequences. So whenever you see a trust named on a beneficiary form, ask who the actual trust beneficiary is and why they are named, and then explain the different options. The trust type and who the primary beneficiary is can dramatically impact how long those assets remain tax advantaged and the overall tax drag on the inheritance. This is one of those spots where the tiny details can capsize the plan. If you don't give clients the full picture, they may come back like Jaws 2 and bite you. You're not advising, you're educating, so clients can make the best decisions on their voyage. Let's dip below the surface and review the rules that aren't used as often, but are absolutely worth knowing. And these are the current advisors sometimes forget until a tax bill hits like a rogue wave. First is the 5-year rule. The inherited traditional or Roth IRA must be fully distributed by December 31st of the 5th year after death. There's no RMDs required. There's smooth sailing on paperwork, rougher seas on taxes. That's why so many of us reasonably assumed, and that's never good to do, that the new 10-year rule would work the same way with no RMDs. But alas, the IRS never misses a chance to keep my mind a well-oiled machine. So here's our example. The IRA owner died in 2025. The account must be emptied by December 31st, 2030. Remember the common mistake, thinking the deadline is 2031, 2026 plus 5. However, 2026 is year 1. 2026 plus 4 equals 2030. So there is the lump sum, which means a beneficiary can take all the treasure at once. But beware, the taxable portion is subject to ordinary income tax, and the tax tidal wave, as many aren't ready for. Here's by Oracle Insight. A lump sum might be harmless if they're inheriting a small amount, say a few $1,000s. But for someone inheriting significantly more, that easy cash out can unleash a tax tsunami. And trust me, the IRS is always thrilled to collect. Now, disclaiming. A beneficiary can refuse or disclaim. All are a part of the inherited IRA. It's generally done within 9 months of the IRA owner's death. Here's what's really important. The beneficiary cannot choose who receives the disclaimed amount. Instead, the IRA will be inherited by the other beneficiaries indicated on the beneficiary form, or if there's none, they'll use the IRA custodial agreement defaults. A strategic reason to disclaim is when the primary beneficiary is a surviving spouse. After review of their finances, the spouse determines they don't need all the IRA assets. By disclaiming part or all, remember, it's their choice. The disclaimed assets flow to the contingents, which are often the children. This can create a significant tax opportunity. The children may receive up to 20 years of distributions by inheriting the death of the first spouse. If they inherit only at the death of the second spouse, they will only have 10 years. When structured wisely, disclaiming can be a deliberate maneuver, one that can realign the inheritance voyage and at times save the entire fleet. Each option carries different tax planning consequences. Would your client know which route to take, or are they sailing blind in a financial storm? As their trusted navigator, it's up to you to help them read the financial waters, avoid hidden hazards, and steer them safely to the calmest harbors. Review the inherited IRA plans today before the tide turns. So our last step in the journey is about the successor Benny. and they're simply the person or entity named to inherit the inherited IRA after the original beneficiary dies. They're the beneficiary, or the next passenger to take the helm and complete the journey. Now, their distribution rules depend on the original beneficiary's category. So let's hoist the sails and explore how these rules unfurl. Here's another twist in the current. How long the inherited IRA or the twice inherited IRA can remain open depends on the original beneficiary when they inherited the IRA and when they died. It's a bit of a puzzle, right? So let's break it down and put those pieces together. If the individual or QT inherited the IRA before 2020, they're considered an EDB under the Secure Act rules. If that original beneficiary or the oldest QT Benny dies before 2020, their successor Benny steps into their shoes. And that just means the successor continues the original life expectancy distribution schedule while taking over mid-helm without changing course. That's easy enough so far, right? But wait, the current's going to shift again. Now let's sail forward and learn what happens when the beneficiary dies after 2019 and the successor must navigate the Secure Act rules. Now these waters may look calm, but the rules beneath shift like hidden tides. Doesn't matter if the successor is an individual or entity, they're not starting a new voyage. They're simply completing the EDB's distribution voyage. Under the Secure Act, a successor of an EDB who dies after 2019 can no longer continue the life expectancy method. Instead, they're going to receive a new 10-year term to fully distribute the twice inherited IRA. RMDs are necessary on the 10-year successor journey because the EDB was using the life expectancy option. Remember that leases rapidly rule. And they're going to be based on the original owner's date of death, the EDB's single life table divisor that was obtained the year after the owner's death, and the term certain method, that's subtracting 1. There's a special rule alert. Remember that rule we discussed earlier? The original owner died on or after their RBD and they're younger than the Benny. The ghost rule applies. Same thing here. You can still follow it. But in either scenario, if the divisor is less than 10, the account will empty sooner than 10 years. Now, when a successor inherits from a DB, their mission is simple but unforgiving. They must complete the original 10-year journey started by the DB. They don't receive a fresh 10-year window. The critical distinction from successors of an EDB who do get the new 10-year window. I want you to think of it like this. A new passenger joins the cruise, but the ship was already locked into its final destination. RMDs on this route are necessary if the owner died on or after their RBD. We're going to use the original owner's date of death, DB's single life table divisor, and the term certain method. But successor bennies don't begin anew. They inherit the course already charted along with its deadlines, currents, and constraints. Make sure your clients understand the rules before the wheel is passed, or they may find themselves off course in unfamiliar waters. Now let's visit our passengers as the helm changes hands. I want you to meet Elmer. He inherited a traditional IRA from his aunt back in 2015, and that was long before the Secure Act waves reshaped these waters. Because of this timing, Elmer's treated as an EDB under today's rules, a sailor with such privileges from the old world. Fast forward to 2023, and Elmer's died, and his name Bugs as his successor, Benny. Here's where the tide's going to turn. Because Elmer died after 2019, Bugs does not continue Elmer's life expectancy schedule. Instead, Bugs is treated as successor of an EDB, which means Bugs receives a new 10-year term to empty the twice inherited IRA. And what's the deadline? 2033. RMDs begin in 2024. As you see on the slide, he now has 8 years left to complete the 10-year voyage. Now, a successor of an EDB has just 10 years to move the inherited assets to the tax wall. There's no stretch, no extension, no wiggle room. Why proactive planning is critical. So ask your clients, should they use distribution smoothing to level the tax waters? Should they front load distributions in lower income years before the tax tide rises? These decisions can make a difference between calm seas and bracket busting storm. So we're going to change course and see what if Elmer was a DB. Because of the Secure Act, and Elmer inherited traditional IRA from his aunt in 2020, he's firmly in DB waters. There's no stretch, no life expectancy voyage, just the straight 10-year roll. And we're going to go to 2023, and Elmer died, and Bugs is his successor. Here's where some passengers might start feeling seasick. Elmer inherited in 2020, so he's a DB. He was under the 10-year rule. Original owner died after RBD, so that means Elmer had annual RMDs during the 10 years starting 2021. Bugs is now the successor of a DB. He inherits $215,000. If Elmer died early in his 10-year journey, Bugs gets the remainder, 5 years left on the clock. That final year is 2030. And yes, Bugs has to take annual RMDs too. On the slide, you'll notice that by taking only RMDs, Bugs is forced into a brutal final distribution of about $223,000. Yikes, that's not exactly a smooth sunset cruise you'd hope for. Remember that the successor of a DB has the remainder of the 10-year voyage. That means a compressed window to move assets through the tax fall, often when the successor is in their highest income earning years. This is where you step in as the client's co-captain. Again, ask them if distribution smoothing could help spread those income more evenly. So they customize distributions in lower income years to avoid the 10-year tax tsunami. These moments where your guidance can turn a shipwreck into a safe harbor. Land ho, we've navigated some of the most complex waters of the inherited IRA world, and at last the harbor's in sight. But before we drop anchor, let's review the key takeaways from our voyage. We charted the beneficiary categories, we've mapped the required beginning date and the RMD age, and we've explored the distribution path with confidence, kept a steady hand on the wheel. I'll leave you with a few final captain's tips. They're practical insights and a quick look back at today's course. Remember this wise oracle piece of advice. Mastering these rules isn't just about compliance. It's about compassion, strategy, and helping clients navigate some of the roughest seas of their financial lives. Your guidance is the lighthouse. Make sure they can see it. So my first tip is to know your passengers. Identify the beneficiary type first, NDB, DB, or EDB. Their classification is going to determine the rules that follow, the route, the taxes, how long the IRA can stay afloat. Chart the timelines. Understand the owner's RBD and RMD age, because those dates are going to steer the distribution voyage and shape every planning strategy. Watch for those hidden hazards. Misinterpreting the 5 or 10-year rule can send clients straight into a tax storm. You have to clarify timelines, confirm assumptions, or just don't make them. Avoid the reefs others crash into. Don't let the tax tide rise. Help clients avoid the 10-year tax tsunami. Use distribution smoothing to spread income across calmer waters and avoid bracket-busting waves. Remember, spouse has the options, but timing is everything. A surviving spouse may benefit more from an inherited IRA than treating the account as their own immediately. Age, cash flow needs, and RMD timing determine the smoothest route forward. Successor bennies are going to continue the journey. After 2019, successor bennies do not get a new voyage. They inherit the course already charted. Know whether they're following the new 10-year clock as an EDB successor or finishing the partial journey as a successor of a DB. My last tip, update that map. Life events like marriage, divorce, birth, or death demand a beneficiary form review. Don't let outdated paperwork steer your clients in shark-infested waters. The Oracle foresees 2 futures. Those who ignore the rules meet the IRS Kraken, and those guided by you enjoy calm seas and better tax brackets. And remember, nothing delights the IRS more than a clueless sailor. Your clients are lucky. They have you. Now, go forth and keep them from donating half their inheritance to Uncle Sam's Vacation Fund. Thank you for sailing with our inherited waters today. It's been a pleasure navigating this journey with you, and I'm glad to answer any questions. They can compile them in the Q&A, but I wanted to let you know while we're waiting to see if there's any questions that all our hypothetical scenarios were illustrated using our break analytics software. We're going to be sending you a follow-up email, and there'll be a link to the materials if you want to learn more. Yes, you'll be able to see the replay if you're so interested. And if you want to request a consultation to see how our software works with your client's own specific situations, we'd be glad to do that for you as well. So, do we have any questions for us right now?
Looks like all the questions were answered as they were coming in.
Perfect.
Yeah. Wait, inherited IRA client before 2019, client can follow RMD rules for their own life expectancy.
Yes, if a beneficiary inherited from someone who died before 2020, they can use that life expectancy option. It's if they die from 2020 or after, their successor follows one of two rules. Remember, if they inherited before 2020, we're going to consider them an EDB. They're kind of grandfathered in. So their successor no longer steps into their shoes and continues that life expectancy, but that successor gets a fresh 10 years with RMDs. Which age on which chart? Okay, I see that too. So when you're talking about an inherited IRA for non-spouse beneficiaries or entities, it's always the single life table. Remember that spouse has 20 different rules for us. But it's always a single life table, it's term certain. The question is it the beneficiary's life expectancy or using the ghost rule? And those are always very specific. The owner died on or after their RBD. They were younger than the beneficiary. Then they can use their attained age in the year of death the following year when RMD start, you already start subtracting one. So it's just a little difference in the calculation. Now that's a lot to memorize and remember. And again, I've done this for a long time, but that's what our software does for you. You fill out a few questions, it will know the type of beneficiary, how long they have, which table to follow, what the divisor is.
Well, perfect. Thank you, everybody, for spending part of your day with us today. I hope you got something out of it. We did get one more question coming in, but we'll make sure that anybody else, this is the end of everything.
Roger has one in the Q&A.
Yeah.
So the ghost rule. I always like to tell you, that's when the last year the owner had a pulse. So ghost rule is for NDBs, non-designated beneficiaries, when the owner died on or after the required beginning date, or it always has to be, the owner has to always died on or after the required beginning date. But when they have a person and the owner is actually younger than their beneficiary, you can use the owner's life expectancy because the last year they had a pulse and then they become a ghost. That's why they call it the ghost rule. You get the divisor that year of death, and then you start subtracting one. So that's what that means.
All righty. Thank you, everybody.